Alarm bells are ringing from Lennar Corporation, one of America's largest home builders. Executives are frantically dumping millions in company stock. Is this the ultimate insider signal of a catastrophic housing market collapse that could shatter your financial future? What do these insiders know? Are they cashing out before the house of cards tumbles?
My name is Julia and welcome to Market Pulse. Let's get started.
Lennar Corporation, a titan of American home construction, is flashing warning signs, not from its building sites but from its boardrooms. Top executives are engaging in a disturbing pattern of significant stock sales. These aren't minor adjustments. These are insiders, whose wealth is tied to Lennar's success, seemingly rushing for the exits. Why, if they believed good times would continue? This isn't just about Lennar. It's about what their actions might foreshadow for the entire U.S. economy, a potential early warning that the foundations are cracking. Consider Circano Management LLC, managing wealth for affluent clients. They didn't just trim their Lennar holdings, they slashed their stake by a jaw, dropping 44.8% in the last fiscal quarter, a sale of over
320,000 shares,
translating to tens of millions of dollars. This isn't a subtle hint. It's a multi-million-dollar scream that something is deeply amiss. Such a drastic reduction by a major institutional holder often signals a profound loss of faith in the company's short to medium-term prospects, or perhaps a broader strategic shift away from the entire sector due to perceived systemic risks. The sheer scale of the divestment speaks volumes about their conviction that holding Lennar stock at this juncture is an unacceptable risk. Apologists cite diversification or tax planning for insider selling, plausible in isolation, but not when multiple insiders sell amidst economic uncertainty, crushing inflation, and a teetering housing market. SEC Form 4 filings reveal these trades. Are they pre-planned, Rule 10b-5-1, or discretionary? A flurry of large sales, even pre-planned, can be a warning. Aggregated data clarifies if it's a cluster of sales by high-level executives, betraying a collective loss of confidence. We need to look for patterns. Are the sales accelerating? Are they happening at prices near recent highs? Or are insiders selling even as the stock price begins to falter, suggesting a desire to get out at any cost? These nuances are critical. Lennar's stock, despite past growth, it has fallen by almost 50% since its peak and shows significant volatility. Analysts offer mixed signals. Wolfe Research downgraded Lennar to peer perform. Wedbush maintained neutral. Keefe, Bruyette, Woods, and UBS Group trimmed price objectives, though UBS kept a buy rating. This divergence reflects pervasive market uncertainty. When analysts hedge their bets, it often means they see the same warning signs insiders might be acting upon, such as slowing order growth or margin compression. A chorus of caution from analysts should give every investor pause. While Lennar debuts new communities like North River Farms, demand sustainability is questionable amid high interest rates and waning consumer confidence. A new community is a long-term bet. A rocky short-term can doom even the newest development. The glossy brochures don't mention the risk of carrying unsold inventory or offering deep discounts that erode profitability. What happens if the local job market falters or property taxes and insurance costs skyrocket? These are real-world scenarios that have played out in previous housing downturns, leaving developers with massive write-downs. The carrying costs of unsold land and homes can quickly drain a company's resources in a downturn. The company's financial projections suggest a potential EPS decline for fiscal 2025 versus 2024. An EPS decline means lower profitability, pressuring stock prices. Why? Increased material and labor costs, higher financing costs, or a sales slowdown requiring more incentives. Insiders, understanding order books and cost structures, see these headwinds first. They know the true state of demand and see early signs of margin compression. This profit squeeze is a classic warning sign that often precedes broader market corrections. One must also question the reliability of forward-looking projections in such a volatile environment, as these projections often rely on macroeconomic forecasts that themselves carry a high degree of uncertainty. When insiders with intimate knowledge sell significant stock, it's a potent signal. Are they seeing storm clouds invisible to the public? Are they positioning for a downturn, converting paper wealth to cash before the music stops? The actions of Lennar's insiders are a critical, unignorable piece of a disturbing puzzle. Their collective behavior suggests a lack of conviction in the company's ability to navigate the choppy waters ahead, a sentiment that should send shivers down the spine of anyone invested in the housing market. This isn't just about one company, it's about the potential for a systemic shock. Lennar's insider activity isn't isolated. It's set against a U.S. housing market experiencing seismic tremors, with echoes of 2008 growing louder. The dream of homeownership has morphed into financial stress for millions. The affordability crisis is catastrophic. Wage stagnation, soaring home prices since 2020, and high interest rates have pushed homeownership out of reach. Monthly PITI, principal, interest, taxes, and insurance, often consumes 40–50% plus of household income, far exceeding the healthy 28–30% guideline. This isn't just a statistic, it's a daily struggle. Today's crisis is more about sheer price outpacing income, even for qualified buyers, than the subprime lending of the pre-2008 era. The definition of affordable has been warped, locking out a generation from wealth creation through real estate. Slowing sales volumes indicate freezing demand. National Association of Realtors, NAR, data shows significant dips in existing home sales. March 2025 hit its slowest pace for that month since 2009. This sustained trend suggests buyers are unable or unwilling to enter the market. Open houses are quieter, bidding wars have vanished, and properties linger, often requiring price reductions. This buyer retreat is a classic precursor to price corrections. The psychological impact of seeing properties sit also erodes seller confidence and emboldens buyers to offer less. Inventory levels are insidiously creeping up. While more supply might seem good, if unmatched by demand, it leads to a buyer's market and price cuts. Zillow's forecasts, repeatedly revised downwards, now predict tangible price declines in hundreds of U.S. cities, a stark reversal from recent double-digit annual appreciation. Homeowners could see equity evaporate. Markets like Austin, Boise, or Phoenix, which saw extreme pandemic surges, are now most vulnerable. This isn't just new listings. It's also previously delisted homes re-emerging, adding to the glut. Mortgage rates remain a major, persistent headwind. Despite hopes for Fed cuts, rates are elevated. The 3% mortgage dream is a distant memory. The golden handcuffs effect locks homeowners into ultra-low rates, reluctant to sell and take on much higher new rates. This artificially constricts existing home supply, complicating market dynamics and preventing normal churn. New inventory is disproportionately new construction. The longer rates stay high, the more pronounced this lock-in effect becomes, creating a stagnant market. The controversial rise of institutional investors in single-family homes is significant. Wall Street giants have poured billions into buying homes, often with all-cash offers, outbidding families and converting homes to rentals. Critics argue they drive the affordability crisis, inflate prices, and raise rents. A coordinated sell-off of their massive portfolios could trigger rapid price declines, similar to post-2008 bulk sales of foreclosed properties. The scale of institutional ownership today poses a systemic risk often underestimated. Price reductions by sellers are increasingly common and larger. Frenzied bidding wars are fading. Price-reduced signs are ubiquitous. Data from Redfin shows a rising percentage of listings with price cuts and larger average cuts. Sellers are adjusting expectations to cooling demand and mounting inventory. The power dynamic is shifting to buyers. Each price cut sends a ripple of fear, influencing other sellers and dampening buyer enthusiasm for top dollar. All this occurs within a fragile, broader economic context. Persistent inflation, eroding purchasing power, recession fears, rising unemployment in key sectors, tech, finance, and record-high consumer debt. A job loss event, credit crunch, or geopolitical shock could ignite a housing market conflagration. The system is primed for a shock. A housing downturn has far-reaching consequences for consumer spending, bank stability, and overall economic growth. American sentiment is shifting from FOMO, fear of missing out, to FOHO, fear of overpaying, or FOBI, fear of buying in at the peak. Caution and fear drag on demand. When Lennar insiders, deeply enmeshed in this market, reduce personal stock holdings, it's reasonable to connect the dots. They likely see these multifaceted warning signs as concrete threats to their companies and their own financial future, with a clarity and urgency the general public cannot possess. Their actions suggest they believe the risks now far outweigh the potential rewards. What specific knowledge prompts Lennar insiders' sales? We can infer based on their privileged position. This isn't necessarily about illegal trading, it's about their superior understanding of developing trends. Firstly, they have real-time granular data on sales traffic, buyer sentiment, and cancellation rates. Official reports lag. Insiders see daily, weekly numbers. A drop in serious buyers or increased cancellations, from 10-15% to 25-30% plus, are powerful leading indicators. If these internal metrics flash red, insiders know bad news for the broader market is coming. They can also track the effectiveness of sales incentives in real time, knowing if even deep discounts are failing to move inventory. Secondly, via Lennar Financial Services, they see buyers' true financial health. They know of struggles with loan qualification, unsustainable debt-to-income ratios, e.g., above 45-50%, or if more people are scraping together down payments through risky means. Deteriorating borrower quality or increased loan rejections are undeniable early warnings. They can also see trends in mortgage applications, such as a shift towards adjustable-rate mortgages, ARMs, when fixed rates become too high, which introduces another layer of risk. Thirdly, they understand true costs and risks of land development and construction, material cost fluctuations, lumber, concrete, labor availability and wages, permitting complexities, and environmental regulations. If internal cost forecasts trend sharply negative, outpacing their ability to raise home prices, it impacts future profitability and squeezes gross margins. They also have early visibility into supply chain disruptions and understand the true cost of capital for their development projects. Fourthly, they have a panoramic, detailed view of the competitive landscape. They know what rivals, D.R., Horton, PulteGroup, local players, are really doing. Are competitors offering aggressive incentives? Is there a sudden inventory glut? Are others mothballing projects? Knowing the market is becoming a brutal dogfight for fewer buyers would make executives cautious. They also monitor the health of their subcontractors and suppliers and track competitor land acquisition strategies. Fifthly, Lennar's top executives deeply understand their company's own financial leverage, debt covenants, and true exposure to market shocks. Public filings are a snapshot. Insiders know precise loan terms and covenant conditions that, if breached, could trigger defaults or credit downgrades. Internal stress tests, e.g., 20% home price drop, 2% interest rate spike, reveal uncomfortable truths about resilience, motivating personal risk reduction. They are also aware of off-balance sheet liabilities or contingent risks not fully transparent to the public. Insider selling isn't always about today. It's often about anticipated future conditions, 6 months to 2 years out. They trade on broader assessments. If their collective wisdom, informed by proprietary data, suggests an unfavorable risk-reward shift, selling is rational self-preservation. They are not just reacting to current conditions, they are anticipating future ones. Consider Lennar's Millrose Properties, MRP, land asset spin-off. Publicly, it's to unlock value. Could it also be to de-risk the core homebuilding operation by shedding land liabilities before a downturn makes that land an albatross? Land is illiquid. The timing, with insider sales, is telling, suggesting insulation from anticipated trouble. Such moves can also be designed to improve the financial ratios of the parent company. The adage, "it's different this time," is dangerous. Lennar insiders' actions, their significant stock sales amid housing market warning signs, shouldn't be dismissed. It's a signal that those closest to the action may believe good times are ending and prefer cash. Their actions speak far louder than any carefully crafted press release. This isn't just about avoiding losses. It's about preserving capital to potentially reinvest at much lower prices after a market reset. What to make of this? Lennar, a giant, still reports sales. Yet, we see insider sales, a cooling housing market, and a fragile economy. Is this definitive proof of an impending crash rivaling 2008? Not necessarily. The future is uncertain. However, is it a significant, flashing red warning sign demanding utmost attention? Absolutely, yes. When those paid to understand a market, whose fortunes are tied to it, start systematically exiting, we must pay attention. Their actions are calculated, driven by risk, reward assessments based on data we'll see months later. Ignoring such signals can be financially catastrophic. The history of financial markets is littered with the wreckage of those who ignored early warnings, who believed this time is different, only to see their savings, their investments, and their dreams evaporate. The insiders are not always right, but their track record of anticipating major market shifts is far better than that of the average pundit or retail investor. Lennar's insider sales are a potential canary in the coal mine, reflecting larger anxieties and structural weaknesses, not just within the U.S. housing market but within the wider American economy. The American dream of homeownership, once a cornerstone of middle-class aspiration, is increasingly becoming a source of crushing stress. The affordability crisis is not just an economic statistic, it's a daily struggle that impacts real lives, forcing families to delay or abandon dreams, or to take on unsustainable debt. This isn't just about numbers, it was about the financial futures of tens of millions. What do you think? Are these sales prudent planning, or an ominous signal of a devastating downturn? Are we listening to their actions, not just words? The stakes are astronomically high for Wall Street and Main Street families, retirees, and young people. Your decisions today could determine your financial well-being for years. The time for complacency is over. The time for vigilance and prudent action is now.
Thanks for watching. If you found this helpful, hit that subscribe button and hang out with me here on Market Pulse every week. See you in the next one.